Okay, um, so this is chapter 18 in Finance 334. And as you can see, the title of the chapter, Consumer Loans, Credit Cards, and Real Estate Lending. So this builds on previous chapters and it just gets a little more specific in terms of what the different types of loans, some of the characteristics of the types of loans, that type of thing. Now, here we're talking about consumer loans, okay? As you can see in previous chapters, there are loans to businesses are a huge area of lending. Loans to farms are a huge area of lending, but this is specifically about loans to consumers. And so you can see some of the different types here. Residential mortgage loans. We're not going to spend a lot of time on this simply because we spent so much time on it back in chapter 9 in your book, and then also the handout. You've got non-residential loans, such as installment loans or non-installment loans, and then you've got credit card loans and revolving credit. So we're going to spend a little bit of most of the time talking about the non-residential and the credit card loans. Okay, so as we've talked about before, residential mortgage loans, these are loans to finance the purchase of some type of residential property in the form of a house or a multi-family dwelling. And so this is usually a long-term loan, which is secured by the property itself, and we talked about that already. And we said typically most mortgages are either 15 or 30 years, and most people prefer a fixed rate loan, although we have discussed also adjustable rate mortgages. Installment loans, these tend to be short to medium-term loans repayable in 2 or more consecutive payments, usually monthly or quarterly. And they're often used to finance big-ticket purchases or consolidate existing debt. So, for example, when somebody buys a car, a lot of times they finance that car with an installment loan. They have a monthly car payment that they make that pays back the loan. Sometimes people consolidate debt. So maybe they've got 3 credit cards. They've got a balance, let's say a $1,000 balance on each credit card. So they consolidate the 3 $1,000 credit card balances into one $3,000 installment loan from the bank, and then they make payments monthly on that installment loan. Now, one thing about that is in my experience, and I've made a lot of consolidation loans, normally the person or the people who do this, they're doing it thinking, okay, I'm going to get away from the high interest on credit cards. I'm going to consolidate what I owe, I'm going to pay it off, and I'm going to be out of debt. Well, that's fine as long as you don't keep using your credit cards. But in my experience, most people who consolidate loans, they simply end up, they have then a monthly loan payment to pay off the consolidation, and they end up charging more on their credit card, so they get themselves back into trouble. So I've seen really some horror stories of individuals that have in excess of $100,000 in credit card debt. And I've had people who have they've had their house completely paid off, and they had to remortgage their house, take out a mortgage on their house for 30 years, another 30-year mortgage, to pay off their credit card debt. That's after their house was completely paid for. I mean, that makes you absolutely sick to see something like that. So again, I mean, I guess kind of the moral of that story is if you can't control your spending, you don't need a credit card. I mean, just that's kind of how it is. And we'll talk more about credit cards in just a minute. You've got non-installment loans. These are short-term loans by individuals for immediate cash needs and repayable in one lump sum when the borrower's note matures. Another name for this is a single pay note. These, I think, were more common a few years ago than they are now. For example, when I was in college and I wanted to buy a car, I tended to work a lot during the summer, but I didn't work as much during the school year, and so it would have been hard for me to make a car payment during the school year. So what I did is I took out a single pay note, which essentially they were typically for 6 months to a year in maturity. And at the end of the 6-month period, I would go in, pay the interest that had accrued, and renew the note for another 6 months, which would then continue over into the summer. So during the summer, I could not only pay the interest that was accruing, but I could also pay some on the principal of the note. So if you don't have a steady income, or if you're on some type of job where maybe you're commission based or something, so you're not really sure how much is coming in, then sometimes a single pay note might work out better than an installment loan. All right, credit card loans. Credit cards are loans. I mean, you can, there's nothing evil about credit cards. There's nothing magical about credit cards. It's simply issued by a lender, typically a bank, and it's a loan. So when you charge something on your credit card, that lender expects you to pay it back, typically within, your bill's going to come in usually 25 days. Okay, so credit cards, as I said, they're loans. As credit cards offer holders access to either installment or non-installment credit. Banks find that installment users of credit cards are the most profitable to the bank, and banks can also earn discount fees from merchants on their credit cards. So credit cards for lenders, they tend to be very profitable. That's why they're so popular. And I just heard recently that in the United States, we have gone over $1 trillion in credit card debt as consumers. So congratulations to everybody who has some credit card debt. But actually, that's probably not the kind of thing you want to be congratulated on. But we are big users of credit cards in the U.S. and really worldwide, but especially in the United States. Debit cards. Many of you have debit cards. Debit cards can be used to pay for goods and services, but they are not a credit card. A debit card is simply the same thing as basically writing a check. Money comes directly out of your checking account and or your savings account. They're convenient. It's easier than carrying around cash a lot of times. You can withdraw from ATMs. People, I mean, a lot of times your debit card can also serve as a credit card. So it really depends on the type of bank account you have. But you can, as the third bullet point here says, the purchase price of an item bought with a debit card is typically immediately withdrawn from your checking or savings account, as opposed to, for example, old school writing a check. There's normally at least sometimes a day or two what's called float, which means that's the time it takes for the check to get from wherever you're buying it. It goes from their bank to your bank, and then the money goes back. Today, maybe 1 or 2 days at the most. Several years ago, it wasn't unusual to have a 5 or 6 day float, which means people would write a check on a Tuesday, knowing they wouldn't be paid until Friday, but that would still give them enough time to cash their paycheck and have it deposited into their checking account. So when the check did come through, they would have money to cover the check. Well, some free advice, please don't try that today, okay? Because you don't have 5 or 6 days worth of float today like you did. All right, so characteristics of consumer loans. And again, consumer loans can be for anything. They can be used for buying cars, boats, ATVs. They can be personal loans. They can be for medical expenses. They can be to purchase an engagement ring. It can be just for anything, whatever you want to purchase. Now, some of the characteristics. The first bullet point here says consumer loans are profitable credits with sticky interest rates. And so what that means is the sticky interest rates means that the interest rates associated with consumer loans don't change often or as often as other types of loans. So they tend to kind of just stay there. So consumer loans the rates tend to be a little bit higher possibly than other types of loans. And also they just don't move much. They tend to be kind of sticky. Consumer loans tend to be the most costly and most risky per dollar of loanable funds. So what that's simply saying is consumer loans tend to be small. So if somebody comes in and borrows $3,000 to purchase an ATV, you still have to do the paperwork. It still takes the loan officer's time. And so you could probably make, instead of a $3,000 loan, you could probably make a $103,000 loan, and it wouldn't take much longer. So in terms of per dollar loan, they tend to be the most costly and the most risky, with credit cards being at the top of the risk level, which we'll talk more about that in just a minute. Also, consumer loans tend to be cyclically sensitive. What that means is loan demand rises during economic expansions and falls during economic downturns. Now, this might be the opposite of what you think, because a lot of people think that during an economic expansion, people are working more, they're making more money, so they would need to borrow less. And during an economic downturn, they may not be working as much, so they would need to borrow more. Well, actually, research shows the exact opposite. So what they're saying is when we're working and making money during economic expansion, we even want more. So we borrow, and during an economic downturn, at least we're smart enough to know that maybe we shouldn't borrow right now because we can't pay it back. So anyway, that's what's been happening over the last few years anyway. Also, consumer loans are interest inelastic. And what that means is, if you think back to your economics class where you had elastic goods versus inelastic goods, what that means is consumers typically are more concerned about the monthly payment than the interest rate. So an inelastic good, that was a good whose the demand for that good didn't change much when the price changed. Then I don't know what your economics professors are using today, but historically, insulin has been an example of an inelastic good. So if you're diabetic and the price of insulin goes up, you still have to buy your insulin. And you have to, okay? I mean, your life depends on it. So typically, most consumers are more interested in their monthly payment. They really don't ask about the interest rate. And this is actually true, man. I've made hundreds of consumer loans, and typically the question most people want answered is, what's my monthly payment going to be? They don't ask what interest rate am I paying, it's how much is my monthly payment. And the last bullet point here says consumers with higher incomes and more education tend to borrow more relative to their income. And again, this is a little bit surprising to a lot of people, that if you have a higher income and more education, that you tend to borrow more. But again, this is sort of a it's not just related to the United States, but it's big in the United States, in that as we make more money, we tend to spend more money. Some people call it keeping up with the Joneses. Some people call it income creep, or expense creep related to your income. It's just, we make more money, so we think we need a nicer car or a nicer house or a nicer boat or a nicer motorcycle or whatever it is. And so it ends up, as we're making more money, we end up spending more money. Okay, now if you're going to evaluate a consumer loan application, consumer loan applications, they're basically pretty standard. They look a lot alike. You're going to look at the character and purpose of the loan. So you're going to look at the ability of the customer to repay. You're going to look at the customer's credit report. You're going to see if they have or need a cosigner. You're going to look at their income level. So that's going to be the size and stability of their income. And also deposit balances. A lot of people don't think about this, but a bank might look at your daily average deposit in your checking account, and also what's called a right of offset. And a right of offset means that if you have money in the bank and you owe the bank a loan payment, after a certain amount of time, they can go into your bank account and take the payment that you owe them, or the money that you owe them, out of your account. Now, the crazy thing about this, and the really stupid thing about a right of offset, is legally by law, it depends on different states in terms of how much time you have to give. But it says here, typically you have to give the customer a 10-day notice. So what that means is the bank has to tell the customer 10 days in advance that they are going to go into their checking account or savings account and take the money out that is owed to them. Now, the crazy thing about this is if the customer is smart, how much money do you think is going to be left in their account once the bank tells them they're going to do this? Well, you're right, zero. They're going to take the money out of the account. So, is it a way for the bank to be paid back? At least theoretically, yes. Typically, though, there's not going to be any money left in any of those accounts for the bank to take. Also, number 4, they're going to look at your employment. They're going to look at your residential stability. So how long have you lived at a certain address? How long have you worked for your employer? Those types of things, they do matter. I mean, I'm not saying, don't ever move or don't ever change jobs, but I'm saying that if you move every month, that says for the average person that right now you don't have a stable place to live, and so if the bank tries to track you down, if you owe them money, they may have trouble finding you. And then number 5, pyramiding of debt. And what that simply means is that the customer borrows at one institution to pay off another lender. And this is really common among credit card users. So, somebody will get a credit card, they'll charge it up, and then they'll get another offer in the mail, 0% interest for the first 6 months. So they'll take out that credit card, transfer their balance from the other credit card onto the 0% interest card, and they just keep doing this. And they will keep doing it until eventually it kind of catches up with them. Okay, this is talking about credit bureaus or what's called a credit report. And basically, this is essentially information on your credit history. So it's going to have things like personal identifying data. It's going to have your personal credit history. It's going to have public information that may have a bearing on a loan. For example, if you filed bankruptcy, if you have some type of wage garnishment, or if you have some type of lien against one of your assets, then that could show up on your credit report. A lot of people get credit reports and credit scores mixed up, and they are different. The credit report is really, as the name implies, it's a report. It's a lengthy document that has a lot of information about you and your previous credit history. A credit score is simply a number based on various statistical models that establishes a score of how likely you are to repay your loan or how much risk you pose to the lender. The higher the score, the less risk you pose to the lender. The lower the score, the more risk you pose to the lender. And again, keep in mind, this is based on historical information. This has nothing to do with if you're a good or a bad person. It simply is based on your past history with repaying loans or paying your bills on time. Because it doesn't just have to be about loans. It can be about your cell phone bill, your rent, you're paying your electric bill each month. I mean, those things go into your credit score. And probably one of the most famous of these is what's called the FICO score. That stands for Fair Isaac Corporation. And FICO scores can range from a low of 300, although I've never seen anybody with a 300 credit score, up to an 850, although now they have an updated FICO score that runs up to 900. But that's not the only one. I mean, you can have different types of credit scores. And this is just kind of a rough estimate of what's considered excellent credit. And at this point in time, that was 800. Great credit would be 760 or higher. Good credit, 730 or higher. Average, 710. Keep in mind, these numbers change because the economy changes. And during a recession, you tend to see credit scores go down. During an economic upturn, you tend to see credit scores improving a little bit. And you can see just a few. There are more than this, but these are a few different credit score ranges. So you can see FICO, which we talked about earlier, 300 to 850. You can see the FICO Next Generation Score, which is a different measure, 150 to 950. Vantage, which is another pretty popular credit scoring agency, 501 to 990. Equifax, 280 to 850. So you can see that, there's a lot of different scores here. So when you get your credit score and it says 700, or let's say 600, you need to know what range is that based on. If that's based on a maximum of a 990, that's going to be different than if it's based on a maximum of 830. Because a 600 out of an 830 would be better than a 600 out of a 990. Okay, so again, it's based on the range. And when it comes to consumer credit issues, there are a ton of laws and regulations out there. The government apparently thinks that you and I as consumers don't have enough sense to get in out of the rain, much less take out a consumer loan. So they make banks jump through a lot of hoops when it comes to loaning consumers money. And these consumer laws fall into two broad groups as listed here. One is disclosure rules. This mandates telling the customer about the cost and other terms of a loan or lease agreement, and then anti-discrimination laws. So this is to prevent categorizing loan customers according to their age, sex, race, or other irrelevant factors, and denying credit to anyone solely because of membership in one or more of these groups. Okay, so disclosure rules, anti-discrimination laws. You're going to see, I'm not going to go into all of these, but as it says here, there's going to be more about these laws and regulations found on pages 609 and 610 of your book. And also in chapter 18, you can read about these different acts. So the Truth in Lending Act, the Fair Credit Reporting Act, the Fair Credit Billing Act, just a lot of information. So just take a look at this and know in general what these laws tell us. Identity theft. This is one of the fastest growing crimes against individuals. I think I mentioned to you last week about, if I didn't, then I wouldn't mention it now, about somebody filing a false tax return in my name this year, a federal return and a state return. So apparently somebody is trying to act as me, at least when it comes to my tax return. And I'm pretty careful about this. So if somebody can steal my information, I mean, you have to be pretty careful. As it says here, the second bullet point, it can be difficult to detect and costly to recover from. And the Fair Credit and Accurate Credit Transactions Act was passed to counter this growing problem. And one thing that you should be aware of is that consumers are entitled to one free credit report annually from each of the three major credit reporting agencies. The problem is most of these don't give you a credit score. They just give you kind of a synopsis of your credit report. And it's going to look different than the credit report that your bank actually pulls on you if you go to borrow money. So you just need to be aware of that. But you are entitled to one free credit report. And if you are interested, if any of you are interested, you can email me and I can send back to you a pretty short PowerPoint presentation slides that have the information where you need to go to pull your credit report free. But you can also use services like creditkarma.com. That's a pretty decent service. They'll give you an estimated credit score. You can also look at a credit report, and it's free. It doesn't affect your credit when you take a look at that. Okay, here's a term that you need to be familiar with for the test, and that is predatory lending. And basically what that is, that's an abusive practice among some lenders that consists of granting subprime loans to weak borrowers, charging them excessive interest rates and fees, increasing the risk of default. So essentially what that's saying is this is where lenders make a loan to somebody knowing they can't pay it back. And so, for example, let's say somebody comes in and I make them a loan to purchase a car. Or let's say I'm a title loan company, so I make them a loan and it's based on, it's being secured by as collateral their car, which is paid for, but I make it at such an interest rate and I have fees that are so high that I know the person can't pay me back. So what I'm going to do is I'm going to take that, the $1,000 loan that I gave them, and I'm going to then, since they can't pay it back, I'm going to repossess their car that's maybe worth $5,000 or $6,000, and once I tack on all of those loan fees and high interest, that $1,000 loan may end up costing that person $5,000. So essentially, I'm going to repossess their car, I'm going to sell it, and I'm going to keep all of the money. So on the $1,000 loan, as a predatory lender, I have made $5,000. The $1,000 that I originally loaned them, plus the $4,000 in bogus fees and interest. It sounds wrong, it is wrong, and it typically takes advantage of those within our society who are the least knowledgeable when it comes to loans or interest rates or any type of financial matters. Okay, real estate loans, we've talked about this. We spent actually 2 chapters on this, really. Chapter 9 in your book, and then chapter 7 handout talking about mortgage loans, real estate loans. So I'm going to skip through a lot of this. It says real estate loans are among the riskiest loans a bank can make. That's basically referring to commercial real estate. Okay. If you're making a home loan, a residential home loan, most people try to make their house payment if at all possible, because you may not like your house, you may not like your yard, you may not like some things about your property, but you like having a roof over your head every night when you go to sleep. So you're going to try to make that house payment when it's due. Also, for real estate loans, the average size is typically larger than other loans, and they tend to have longer maturities because people are borrowing so much, they have to spread that loan out over 10 years, 15 years, 20 years, 30 years, sometimes even longer than 30 years. And again, we've been over a lot of this, so I'm just going to kind of let you take a look at this yourself. It's pretty self-explanatory, factors used in evaluating real estate loans. Also, home equity lending. This is where it says a homeowner can use the difference in the home's estimated value and the remaining mortgage balance as a borrowing base. So for example, let's say I've got a house, it's worth $100,000, but I only owe $50,000 on it. So that means I have $50,000, the difference between what I owe and what it's worth, as what's called owner's equity. So I can take out a home equity loan based on that $50,000 worth of ownership that I have in my house. And I can use this for basically any purpose. I mean, I can use it to put in a new swimming pool. I can use it to buy a motorcycle. I can use it for whatever. But one of the big things is back in 1986, which I understand was a long time ago, but this allowed the interest on most home equity mortgages to be tax deductible. So you can put in your swimming pool, and if it's a home mortgage loan, you can typically deduct the interest that you paid on that, and that's a big help. When you can deduct the interest on your home equity loan, you can also deduct the interest on your first mortgage, your normal home mortgage. So that's a big benefit also. Interest-only mortgages, as the name implies, that's where simply the borrower pays on the interest only. They don't pay on the principal. These were popular when real estate prices were really increasing fast. So investors thought, I can buy the house, I can take out an interest-only mortgage, I can own it for a year, and then sell it and make several $1,000s after I've paid off the interest. And that worked for a lot of people until real estate prices started dropping, and then you saw a lot of people that were really hurt by these interest-only mortgages. The APR, the annual percentage rate, says this is the internal rate of return that equates the total payments with the amount of the loan. And the Truth in Lending Act requires that this rate be disclosed to all consumers on all loans. So if you take out a consumer loan, you're going to see in a box on your loan papers. It's going to be in dark print, and it's going to have what's called the annual percentage rate, which tells you the true cost of borrowing the money. So it takes into account some fees and the effects of compounding. And simple interest loans, it says with simple interest, the customer only pays interest on the amount of the principal left. And it says first, the declining loan balance is calculated, and that reduced balance is used to calculate the amount of interest owed. So essentially, with simple interest, you're just paying interest on the amount of money that you owe. And as you pay down the principal, that means you pay less in interest. A couple of these others I'm going to let you read on your own, the discount rate method and the add-on loan rate method. So you can take a look at that. The rule of 78, I'll also let you take a look at that on your own. Interest on home mortgages, we've already looked at this. We looked at fixed rate mortgages and adjustable rate mortgages back in chapter 9 in your textbook. So I'm not going to spend more time on that. Also points. We talked probably more about points than you actually wanted to ever know. So you can take a look at this, but as you know, a point is simply 1% of the loan amount, and a point is prepaid interest. That's all it is. And that is the end of chapter 18.